Welcome to the Broken Pie Chart Podcast, episode 334. I'm your host, Derek Moore. Back with me a second time. We let you back. Trading manager at Zega Investments, Shane Skinner. What's going on, Shane?
You know, second time's the charm, right? Or third time, but we'll call it second time this go around. It's a pleasure to be back. It's been a fun week.
A little bit.
Exciting stuff coming up in the market here in the next couple of weeks. So a lot to talk about.
Well, first, I want to get to, I've been bashing the University of Michigan sentiment surveys. And sometimes surveys, I often wonder who they're surveying and all that. But anyway, 1 year forward inflation expectations by party affiliation. This was from Michael McDonough over at Bloomberg. And basically, the headline is 4.4 is what people think inflation will be over the next year. We're like 2.6, 2.7-ish right now, not 4.4. Okay. Republicans say 1.3, so less than we are right now. Independents 5.6, Democrats 7.7. So Democrats at one point were almost 10%, I think. So this is why this is useless in my eyes. But if you want to know what people are answering surveys, depending upon the party affiliation, they think inflation is going to be way higher than it is. So I don't know, Shane. I find these useless, but it isn't. It's useful to me because there is some sentiment. And I think we've seen there are individual investors, and they did it 4 years ago with a different president. They're doing it 4 years ago now, or 4 years forward now, or right now, I guess. And, you know, sometimes it's like, if this is the sentiment, this actually tells me that there's still money on the sidelines saying, I don't know, we're going to have almost 8% inflation over the next year, Shane.
You know, first off, with any sort of data, right, statistics, I think it's really important to point out the fact that I can get, if you let me interview whoever I want on whatever subject matter I'm, observing or trying to collect data on, right, I could probably get that data to look however I want it to. If, there are certain ways people lean or groups lean on that subject matter, if that makes sense. So I agree with you 100%. Anytime you're looking at any bit of data, whether it's the Fed, University of Michigan, us as individual investors or money managers, you gotta look at the sample as well, and try to be as non-biased as possible in all of it. With that being said, I think there is almost a desire amongst Democratic politicians to see inflation, not because they want people to hurt, but because they want the whole trade war thing to blow up in this administration's face. I don't think we should wish for that, no matter how we feel about anybody, right? At the end of the day, we should hope that inflation doesn't get bad again. At this time, it hasn't, and it doesn't seem like it's getting hotter at the moment. We are seeing finally some countries coming to, talks and deals regarding trade. So I don't think this is a situation where, given like the current trajectory that we're on, it doesn't seem like things are going to get hot anytime soon. It would have to take some unforeseen sort of black swan catalyst. And again, the market's not here to price in those all the time, right? That happens when it happens, and then the market adjusts. We can't fearmonger every day of our lives.
One thing I would say too is a lot of people who are looking at this, and remember, 29 of the 30 leading economists said there were almost 100% chance we'd have a recession in 2023. Okay, apparently that didn't happen. So a lot of people who are looking at stuff like this, I think what they're leaving out, and I don't want to spend too much time on this, but it's like, okay, you brought up tariffs. So when you look at tariffs, the thought is that tariffs will cause prices to go up. And one of the reasons why the Fed has alluded, and we'll talk about the Fed, that tariffs, that interest rates, what they do they need to keep interest rates high because we might have inflation because of the tariffs. But what they sort of miss in this picture is that if you raise prices, that essentially may tamp down demand as well. And so the Fed is keeping interest rates high to tamp down demand because they worry that tariffs will cause inflation. If prices went up, it would tamp down demand anyway. People buy less stuff when it goes up, or they do substitutes. So, I mean, let's just talk about the Fed for a second. Let's pivot there. I don't think anyone is expecting the Fed to raise interest rates or lower interest rates, sorry, at the next meeting. I'll give you the numbers here. July 30th, there is a 0.47% chance. No, actually 4.7. Sorry, I didn't mean to undersell the chance for a cut.
I was going to say I'd buy that. Send that my way.
Yeah, you'll trade that with me. But 4.7% chance of a cut. This Fed has been very telegraphic about what they're going to do. There hasn't really been a time where they have not projected what they're going to do. The only time they did, I think when they did, 50 basis points in cut instead of a 25, I forget when that was. But look, I mean, usually people host on these shows say, "Oh, well, they cut." Well, I mean, we can just move on from this. They're not cutting at the next meeting. Would you agree?
I would think so. Powell hasn't given any sort of indication that he would. Now, what's interesting, and I don't think Powell would do this. But with the hot seat that he's in, with the administration and them opening up a potential investigation into the renovations of the Fed and things of that nature, did he misspend money? Not to dig too deep into that, but if for some reason he all of a sudden wanted to flip the script to appease the current administration, maybe. But again, it doesn't seem like he has any desire to be
accommodative.
No. I think he's gonna sit here and do this, and he'll, if they don't remove him early, he'll write out his tenure. I doubt I don't even know if he's gonna cut from now until I think he's out in February. Is that right? It'll be 4 years in February.
Yeah.
Is that correct? Yeah. So at least at this next meeting in July, I'm with you. I think there's slim to no chance here that we see anything happen.
By the way, we're getting a little bit of air on the mic, so maybe just move it away from your face there. But as we, let's think about that for a second. I don't believe he can get rid of Powell except if there's some sort of cause. But here's an interesting thing. So it's a 12-year term as a governor. So you're appointed a governor. And usually there are a number of governors from, like, there's the vice chair, and then these regional bank presidents, they rotate in, and some are voting members some years, some other years. So if we go back to Janet Yellen, she was confirmed as a Fed governor, I believe, 2020 or 2012. So she's a Fed governor. It's a 12-year term. So it's 2024. When you're appointed, as you just alluded to, Shane, Fed chair, it's a 4-year term. So when she was removed, or she was found out she's not going to be re-upped as Fed chair, she decided to step down and resign. But in theory, Janet Yellen could have stayed on as a Fed governor, not being the chair anymore through 2012. Now, I did look at Jay Powell, and I believe that his term as a Fed governor effectively would be done in 2026 anyway. So it's sort of a moot point. And I doubt anybody would stay, just like Yellen decided to leave. But I mean, we're coming up on February. At this point, my guess is he probably has somebody else. Trump probably has somebody else in mind that he wants to put in there. I don't think him cutting. Do I agree that rates should be this high? Probably not. I mean, I think we talked about this last time. 3.5, somewhere between 3.5 seems like more of a natural rate of interest, but yeah, let me paint the picture to the audience, for the audience too, Shane. September, there's 59% chance of a cut. October, they penciled in a cut, so that would be October 29th. December, So the way you read these is if it's minus 1.8, two cuts would be, two 25 basis point cuts. So they're saying 1.8 cuts by then, which basically says, like a 65% probability of a second cut. And I don't know. I mean, January is when you get the second full cut. It's priced in. So just like a couple years ago, when everybody said there's going to be 8 cuts, and Jay and I said, I don't know, they might just leave it. I go back to, do you really want them cutting for a reason? The reason would be the economy is falling. And sometimes, I don't know. I mean, if it would help housing, but the market seems just fine. And we had interest rates like this or higher in the 90s, and the markets were just fine. But I don't think it matters at this point for the market. It does matter for the housing market, though, Shane.
Absolutely. And that's, being 27 years old and, family of 3, right? We are eventually hoping to buy. And that's where, I get the concern that if interest rates get lowered, it creates the resurgence in demand that they're trying to, quote unquote, avoid. With that being said, I really don't foresee how lowering interest rates in this environment will somehow ignite a fire in inflation, at least with respect to the average everyday consumer staples that people need, right, to live day to day. And so I do in some way have concern about what might happen in real estate if interest rates lower, right? There's a lot of stuff on the market right now, but does that all start to get gobbled up again, after rates come down, say 1 to 2% in the coming years, maybe more, who knows? But I think that's the area of the market that needs it the most. Are people who are looking to become first-time home buyers, or people who maybe bought over the past 4 years thinking interest rates would be lower by now, and they're not. You've been really, really sitting on your hands here, waiting for Powell to do something, and he continues to sit. So
There's a case, though, that they could lower rates and interest and mortgage rates don't go down, because they control the short end, and really it's the 10-year Treasury that's. So we can see the 10-year Treasury go up if growth if that's the growth expectation. I'm gonna say something contrarian too, and it's interesting. You mentioned your age. There's a lot of people in your age group who say housing is, it's so unaffordable now, and I would argue that when you look at the average square footage of a house on the market is higher than it was 30 years ago. So you have the size per square foot, you have the interest rate, and certainly interest rates are higher now than they were in 2021, but compared to the 80s, compared to the 90s, it's not so different. And then you look at the price of the house. So you have the price of the house, the interest rate on your loan, and the price and the average square foot. And I would say that a lot of people adjust the price of housing for inflation, but they don't necessarily adjust it for how houses have gotten bigger. And I think if you do that, housing is actually not as expensive as people think it is. It really isn't. It's a contrarian thing to say.
Yeah, no. I haven't ever considered it in that light. And in retrospect, I look at, the house my grandma still lives in to this day that was built by hand by my grandpa. And, before that, they lived in a Sears house, right? You ordered it off a truck and built it your property. But those are smaller houses, right? They're really not that big compared to the average subdivision home that you see that's pretty standard across most of America. I think another thing that it's all about location too. I sound like a real estate agent, right?
Oh boy, here we go.
It's all about location, right?
I feel like I'm going into an infomercial here.
I know. Yeah.
Continue.
Let's be realistic. If you're living in Chicagoland and you're wanting to send your kid to one of the best schools in the area, it might cost a little bit more to buy the same house per se than one in an area that doesn't have as quality of schools, right? So, and just the local economy, right? This is where we're going super micro, briefly, but it really, it's a multitude of things. And I think that what more than anything my generation struggles with, and I myself have struggled with, and I'm getting a lot better at, and it's taken time, right? But it's control, and it's the FOMO of, just spending money in general, right? The fear of missing out, whether it's going out, doing something, having something, right? And, realistically, no one, I don't think, in their 20s or early 30s, right? Or at least most people probably never bought a house and also just bought whatever they wanted and went on whatever trips they wanted all at the same time, right? You can't have your cake and eat. And
Somebody used to tell me you can either do things or have things. You can't have both.
Both. Yep. That's brilliant. And it's so very true. And that's one thing that, unfortunately, like I said, I think my generation and a lot of younger ones, we really like experiences. We like to go out. We like to do things. But at the same time, if you truly want a house, right? If you truly want financial freedom down the road, it's, what you do in your 20s and 30s, right, is going to determine how you're living in your 40s and 50s.
It's the big stuff. And I can tell you that I probably will be in my next book, but I've done a podcast episode. I don't even know how many years ago. It was the title was Netflix is Not Making You Broke. This is probably, I would imagine it's in the first 20 episodes I did. And it was the whole point of, like, there's very big things, and there's cars, there's houses, there's college, there's a number of big things. And I think a lot of people worry about, downgrading from the premium Netflix down to the whatever tier under that. I don't even know. I haven't looked at my Netflix account in a while. But it's really some of the, the larger spending. All right, but back to mortgage rates. So most recent one, 6.75 on a 30-year. And the 10-year treasury is about 4.47. So it's about 225-ish basis points. That is wider than it normally is. And historically, on the average, it's about 170 basis points difference between the two. So that could narrow, and rates could come back down to about 610. But, unless we get a significant drop in the 10-year yield, you're kind of where you are there. And we are at rates not seen, if we do one of those, you're looking at rates that are close to where they were in 2006. So, when I bought my first house, I was ecstatic to get under 8. And it was, So anyway, all right, let's move on from housing. I knew
what mortgage rates were in 2006. I think it was 9. So
yeah, I'll get you a book on. There's a book if you really interested in interest rates. It's like 10,000 years of history of interest rates. So
I would love that, please.
All right, I'll put it in the show notes. So let's talk about Sam Rowe put something out from Goldman Sachs in his, I think this was in his newsletter, foreign revenues by region for the S&P 500. So this gets to the dollar conversation, the weaker dollar that we're having. And it looks like if you go, the S&P 500 share of sales derived from outside the United States, 28%. The Mag 7, though, 49% of sales are derived from outside the United States. That's interesting because these are the biggest companies, and these are the ones who, remember when the dollar was strong, they would say, oh, but for the strong dollar, our earnings would have been higher. I still think this is a tailwind for some of these companies, and the fact that a weaker dollar actually helps them. But I was a little surprised that overall, because remember, it's just aggregated in, all the earnings that come in all go into the same pot. So I don't know. Does this surprise you? 72% only, or 72% from the US, 28 outside. I mean, 50-50 that seems
I,
more in line.
you know what, 50-50 seems more in line. What I find most interesting is how over the past couple of years the talk of geopolitical interconnectedness, right? Like global trade, right? Some people argue we're too heavily reliant on global trade. Some argue that that's what we should want. What I think fascinates me most about this more than anything is that it's just proof to the existing structure that for the time being, global trade is going to have to continue, right? And if there is a major shock to global trade or supply chains, right here is your proof as to why certain names or a lot of the market in general here can take such a drastic hit. It's because 25% of the S&P's share of sales derived from outside of the United States. Sorry, 26%, according to Goldman Sachs International Revenue Exposure by Index.
Don't you think it would be interesting, Shane, if they had those same breakdown, but your input cost? So what percent of your is the S&P company's input, the cost of their goods, or the cost of, the stuff they spend money on to produce the end product? I'd be curious to see that, because we definitely source a lot of the products from overseas.
No, absolutely. Well, that would, I would think, give us insight into the margins, right? Relative to like global sales versus domestic.
Yeah, no doubt. I mean, so we were talking about the dollar. I thought it was interesting to look. Samra always puts out some really good content. And I think when you look at this, it's why I believe, and it doesn't, just because I think this doesn't mean the market's going to go up or down, or sometimes companies beat revenue and earnings estimates and they still go down. But I tend to think as we get to the Mag 7, we get to some of the, I feel like they're going to do better in earnings than are expected. And I think the weak dollar is going to be a tailwind, both this quarter and into next reporting quarter, which of course be the quarter we're just in now. Some other numbers. So the S&P 493, 26% outside of the US. S&P as a whole, 28. The NDX, which is the NASDAQ 100, is 45%. Not a surprise there, because that's more heavily weighted to a lot of those names. The mid cap, 25%. The Russell 2000 at 21%. So, all right. I mean, this is some interesting numbers. Let's go to earnings. Did we cover the Fed enough? I think we did. I think we covered the Fed already.
Yeah. I mean, I can talk to the Fed or talk about the Fed for hours, but
let's not do that.
I don't want to put our viewers through that. So,
well, there's no viewers. There's only listeners. But we've had requests to do this, but sometimes it's just easier doing the audio only. I want to talk about earnings, though, and I like to look at. So we did a show a while back, and it was kind of this idea of where returns come from. And is it Augustus? There was a hedge fund that did this really analytical piece. If I can find it, I'll put it in the show notes. I don't know if I can find it. And they were kind of looking at over these 10-year periods. Let's say a market starts here and then it gets to here. And even just one year to the next. Well, if your earnings grew 10%, but the multiple, the price to earnings, stayed the same, you didn't buy back any shares. Let's say you paid a 1.5% dividend, and then like your sales didn't change. So in other words, nothing changed, but your earnings grew 10%. So, okay, that's it. The market's up 10%, and that's the attribution. But let's say your earnings were flat, but the multiple, how many times earnings people are willing to pay, increases 10%. Well, all else equal, the market's going to be up 10%, well, plus the 1.5, and so 11.5. So when you think about the attribution on what drives a market from one year to the next, it's growth in earnings, and that's really over the long term. But it could be growth in sales, and it could be growth in sales, and assuming the same margin, it attributes back to the earnings. But I think where I'm getting with this is, you don't know where the earnings are going to come from. Like if you buy back a lot of stock, all else remaining equal, your EPS, your earnings per share, will go up because it's your earnings into the number of shares. And so this hedge fund, what they did was they looked at over a decade, from the start of the decade to the end, like what percentage annualized of stock did they buy back, and net buyback, not issuance. They looked at the average dividend, they looked at the growth in earnings, and they looked at the growth of the multiple. And what you find is a lot of times the growth or the multiple contraction is one of those things that is responsible, especially when you have down periods. I became fascinated in this, Shane, just because, although I'm a technician at heart, it just so interests me. And when you look at where we are right now, we're 24.77 price to earnings trailing over the last 12 months. The forward estimate is 23.21, and we're roughly estimated about a 13.5% profit margin. Now, people also say the profit margins, that's got to go back to 6, got to go back to 10, the long run average. I would say these are different companies that are in there right now. But you have all these moving pieces. So sales could increase, and typically over the long run, it's about 3.5%. But what we've seen over the past, decade or so is margins continue to increase. For every widget that's sold or every service that's sold, you're gaining more of your total cost of that. So I don't know, Shane, have you ever spent time just looking at this aspect of it? It always fascinated me from a point to point.
Outside of one of very close professors in college beat statement of free cash flows into me is, look there in the statements. But outside of that, gross margins is huge right now. In a big name with earnings this week, Tesla, right? It's a perfect example. You asked if I've looked into this or paid attention. I mean, I think Tesla's a prime example in the past year of what has happened with a company where gross margin takes a hit. Specifically, I think it was their auto margins. They got just absolutely crushed last year by price cuts. And so, when something like that happens to the bottom line that drastically, when it expands or contracts, I think that, if you're looking for the answer in the statements, it seems like that's about where it usually ends up being.
So basically what you're saying is, let's say the multiple stays the same, the sales stay the same, and they may or may not have in Tesla,
Right.
We're not going to go through their balance sheet or their income statement. But if margins shrink, all else equal, your earnings per share go down because your margins go down.
Exactly. And so that's
but there's multiple contraction too in Tesla for sure. So you have margin shrinking and multiple contraction, but then the multiple expands. I mean, this is why this is a tough game.
Well, that's what I was just going to say. I think they are going to be, the street, when I say the street is probably going to be pretty focused on that. And if they can even stabilize, maybe not even a sharp expansion, but a stabilize from where we were the past couple of quarters, year over year, to maybe even slightly back up, that something like that could, be explosive for Tesla, because all of a sudden, it's turned, right? And now all of a sudden it's trended back in the right direction, with respect to that little formula that you kind of put together. I mean, you showed me the Excel list one day of all the different things and how you weighted it, looked at it over time. And, what I think you're doing is, you are being a technician. You're really trying to get to the core of why a stock or the market itself really does what it does overall on an annual basis. And It seems like it comes down to multiples and margins.
Multiples are huge, and this is why we sort of buy and hedge. I mean, that's one of the core things we do. We do a lot of other stuff these days too, but in the end, we try not to pick when market's going to go up. You don't know what the multiple is going to be. If you want more information on that, you can always reach out derek.moore@zegainvestments.com. That's DEREK. Z is in zebra, E is in Eddie, G is in George, A is in Apple. Investments is up to you to spell correctly if you want to reach me. But just looking at Tesla and the price, the forward price multiple is 161 right now, the next 4 quarters. Am I reading that right? Price to, and let me see. So you know what? They have an earnings. We might as well talk about this, Shane. They got earnings next week. And we always like to talk about what the expectation is for the stock movement. Shane, I'll give you the numbers here and you can tell me what this means. So, they report next Wednesday, next Friday's options, which incorporate the Wednesday. Implied volatility is 66. So take us through what that means when a stock has an implied volatility of 66.
So essentially, implied volatility is a fancy word for telling us the expected range that stock's going to trade in, right? So based off what we're seeing in Tesla options, they're telling us they expect a movement up or down of, it's 66%, you said. Do we have that broken down into the plus or minus in dollars?
Yeah, on a 1 day, one standard deviation move is about 4.15%.
Okay.
And since this is
and we're trading at
5 trading days, right? So the square root of 5 times, what did I say, 4.16?
4.16. Yep. Square root of 5 times.
Yep. So it's about a 9.3 over the next 5 trading days, 9.3, one standard deviation move, up or down.
Up or down. So basically the market is saying, hey, we are 68% confident, roughly about 68, based on one standard deviation, right? Up or down, the Tesla's going to trade within that range. Now, for those who like to dabble or learn more about the option space, that's a really crucial factor in the pricing element of options, right? That probability of it being inside or outside a given price range and by how much, it's all odds, right? And so that definitely impacts the value of options. And so what's going to happen, right, is, that might go up, that might go down, that might stay flat going into earnings. I believe you said Wednesday. After earnings, the news comes out and the market has a little bit more clarity as to the future of Tesla. So with that clarity, right, certainty, comes the ability to more accurately price Tesla after the news is broken. And that's where we'll either see vol expand because the market was not pricing in or aware of something major within the announcement or the financials, or vice versa. It will contract because everything's good, the market sort of got what it was expecting to get, and then that range will shrink. The volatility will come out of all the options. That's what we call the vol crush, or did back on the trading desk days.
So to put some numbers on this too, Tesla closed today 329.55. That level of expected one standard deviation says, and this is why buying a straddle, meaning buying a call, buying a put, is a dangerous trade because it's really a vol trade. You could have the stock go up about 9.3% between now and Friday, and that puts it at your break even is 361.08 or 297.91. Means it has to move a lot. That's quite a bit because you're paying for both sides. And if it doesn't move that much, then you lose money. Like if you're doing this at home, like don't buy a straddle between and don't sell one either. And I'm not saying don't buy it, don't sell it. What I'm saying is if you sell this and it moves more than expected, you're going to lose money. And you can lose unlimited money in theory to infinity, although I haven't had a stock that went to infinity yet. at least not one that I own. Or,
Hey, one day.
if it doesn't go down, if it goes down more than expected. So these are tough trades.
Well, they're also not defined in their risk, right?
No, not at
Because
all.
if you're short a straddle, you're naked put, naked call. If you're long a straddle, well, there is defined risk, but again, it's going to be expensive, especially when you're buying it on an earnings play like this. And, if you're right, it could pay off great, but if you're wrong, you could lose a lot of money and vice versa, in the opposite direction. What I think some people um, fail to understand, or the way they sometimes trade those, is it's just a pure directional. And again, like you said, that's a vol trade. And if someone's insistent on trading vol, there are ways to do it in risk defined manners with the flies and condors. But even then, at that point, it's right, we're not really trading directional, we're trading a range. And so it could be really, really tough. And if you're playing something right with options that statistically is likely to happen based on what's being priced in, the risk reward's not going to be great. And if it's the opposite, it's going to be a great payout, but the odds of it happening aren't very high, right? So
All right. So Tesla Wednesday, let me just look across the board. It starts to get a little crowded next week as far as the earnings front. If I look and I got on the same page here. So GE is next week, or GE Verona. I guess there might be one on the same. American Airlines, Intel. Oh God, I mean, I just remember in the 90s, Intel was basically as important as Nvidia and Microsoft. I mean, it was the one stock for a while. But Verizon, Coca-Cola, and I'm looking across the board. Anything else that's
keep an eye
interesting?
on Coca-Cola and keep an eye on the price of sugar. This is not a recommendation to go buy or sell sugar by any means, but with the recent announcement that we might be getting pure sugar and Coke from now on, if that actually goes through, I'm interested to see what happens to the price of sugar, and if Coke has any comments in the future. I know Coke is not the most exciting thing to trade necessarily, right? It's more of a value stock than a growth, but um, that news headline this week, just I thought it was funny, and I want to keep an eye on it. So um,
Yeah, it's sugar. Sugar is interesting because there's actually a world price and there's a U.S. price. We have to kind of protect the domestic, and I don't think it's a good idea, but if you protect the domestic sugar industry and you have quotas. So once people buy, once a certain amount is bought of foreign sugar, I think it equates to something like 100% tariff. So Brazil and Mexico could be awash in sugar, trying to take it at any price. But since we have these quotas, you sort of have those. I did look at the price of sugar, and I got to be honest with what's this white sugar on the ice, the October contract. It had based. It is moving higher. It is still lower than where it was in May. And if I look at, I got to be honest, I haven't looked at a chart of sugar in quite a while. Let's see, sugar number 11. That's the world contract,
we
and
were
this is the
cocoa
last.
last meeting, we're sugar this meeting.
Yeah, I
Gotta
mean,
keep the softs in mind.
no, I
There'll
mean,
be
look,
orange sugar next time.
there's been a downtrend in sugar. Started probably February and March, and if you were a technician, look, I have no idea. It's we don't trade these markets, but it's anyway. Maybe it's based, maybe it's trying. I don't know. Good luck if you want to trade commodities. You can look that up. All right, Shane. I think we got to, we're getting into earnings season. So to me, and look, I don't know what's going to happen. You don't either. That's why we buy and we hedge. I don't know. I feel like companies are going to surprise. And I'm really curious to see what the analysts do on the forward estimates, because they did get taken down with the tariff stuff. We know we have August 1st coming up, the deadline where 30% tariffs will go in against Europe. If we have any, and I know we have a lot of listeners across Europe. We did lose one. Somebody stopped listening because of the tariff stuff. So hopefully we get them back. But send me emails, derek.moore@zegainvestments.com. Shane, Any recommendations this week?
You know, one of my favorites of all time, we watched it earlier this week, The Big Lebowski. I'm sure plenty of people out there have seen it. It's raunchy. It's Jeff Bridges, right? But it's one of my favorites. So that was one we visited. And then I was told by one of our newer traders to give the Formula One series on Netflix a try. And it seems like all the cool guys like you and our other traders and sales guys love Formula One. So I think I'm going to hop on the bandwagon, give it a watch.
All right. Yeah, that's Drive to Survive. It's on Netflix. It's got to be like 6-7 seasons right now. That's how, when I started watching that, I wound up getting into Formula One. So, and the F1 movie, I talked about it last week, I think, right? Or maybe the week before. It's incredible, I think. I mean, even people who don't like F1 liked it. Did I talk about Mission Impossible? Did I talk about that last week? I went to go see it. The Final Reckoning. I don't remember if I talked about that. It was good. It was long. It was almost 3 hours, but I thought it was really good. Tom Cruise gave you exactly what you want if you're a fan of Mission Impossible, which I've been. And even though it was, I think it was close to 3 hours, I thought he did a really good job. And there was some callbacks to some previous movies. Did I talk about this, Shane, last week? Or I can't remember. Nope, you may have dropped off. I don't hear you anymore.
I think you did, but
Okay.
There is one thing I do want to say with all the movie talk. I believe and this is again not, promotion by any means, but I think Wedbush just raised their target from like $3 to $4 or something like that on AMC. I think people are going back to the movies again. It's slowly happening. I'm seeing it more here. We also have a drive-in out here near us that does double feature every weekend. So we did take the kid to see the Lilo and Stitch movie a little while back. And, for me, it was full circle, right? Having seen that with my dad in the theaters when I was a kid, now taking my own. But no, I think movies are back in. I think people are starting to get tired of the streaming and they like going out and, the experience.
Well, F1 and Mission Impossible are two movies that I felt like I needed to see on the big screen and to see, we don't have, I think we have a laser IMAX out here, but I've heard from people who have seen it in California, New York, the real, maybe you have a real IMAX in the Chicago area, but like the biggest screen possible, the full IMAX, not the laser replication. I heard it's awesome. So maybe we'll see. I'll have to take a look at the fundamentals on AMC. I got to be honest, Shane, I'm not necessarily researching that on a normal basis, but all right, good stuff. I know we got to run. We got some stuff to do here on some wrap up on Friday afternoon, but thanks for coming on again, Shane. Appreciate it.
Always a pleasure. Thanks for having me, Derek.
All right, everyone. Shoot me emails. Send questions. I think we've gone 2 weeks without getting a listener question. So send those over to us. We'll take those maybe next week, or if it's a good question, we'll definitely take it. Even if it's a bad question. I like reading the bad ones too. See you, everyone.